Hi guys, hope everyone's well and welcome to this month's webinar. Now, what we're going to be doing this month is obviously talking about the mini budget. I know that seems a long time ago at the moment, but we're going to be talking about the mini budget. We're going to be talking about what's it done to the property market? Has it actually crashed the property market? Is the property market still any good for actually investing in? I'm going to move this screen because it looks a little bit blurry. I don't know whether that's the camera at the top, but yeah, so we're going to be talking about everything to do with what that budget did, and then obviously a bit about the future as well. So of course we're going to have some questions and answers at the end. So look, without further ado, let's take a look. So first things first is when we go back to the mini budget and what they did, and the whole sort of furor around the issues. What we've got to look at is why did it actually fail in the first place? So the first issue was the fact that once the budget was announced, they couldn't actually understand. When I say they, whether you see banks or whether you see the International Monetary Fund, all these people that commented on the UK's budget, they couldn't understand how they were actually going to level up the borrowing with the actual spending. So, for example, they lowered taxes. So what was initially thought was actually, well, if you're getting less tax receipts come in, how are you can actually keep up with your spending payments and your interest payments because you borrowed so much money over the last X amount of years. So that was the first thing. There was a big disparity between our spending and our borrowing. And of course, you only have to take that on a micro level from an individual. If you spend more than you bring in, then of course, eventually you're going to be in a lot of debt. There was a global concern how the government was going to pay back the spending as they lowered taxes. So what we basically saw there was an announcement on lowering taxes, and there was an announcement on how they're going to actually get money in our pockets, but there wasn't actually any announcement on how they're going to actually save money from what they're spending on things like NHS or foreign aid, etc., etc. They then had to, the way the government actually borrows money, or one form that the government borrows money is through gilts. So investors, there could be retail investors, it could be large-scale investors, they go and buy gilts, which essentially is a loan to the government, and the government then turn around and say, we will pay you X% on that particular loan. So what was the biggest concern is pensions may have a lot of gilts because it's regular income coming in for the pensions. Well, what the biggest concern was that actually can the UK government afford to pay these gilts back? So what actually happened is the Bank of England had to step in and buy a number of these gilts to sort of shore up the market. So gilt prices increased, and it's kind of like this downward spiral. Gilt prices increased, so then of course the government then have to pay more interest back. So there actually more money going out of the coffers. So suddenly there's this downward spiral where they think, well, actually every time that they have to pay more money back, it's more debt for the government. So can they afford to pay it back? No. So the gilt prices increased, and so on and so on. So that's basically what was happening. So the Bank of England stepped in to buy the gilts, but this had a finite date. Now, a lot of people have asked, and a lot of people have actually said, well, do I think it was a poor budget? Overall, I don't think it was a poor budget. I think it was a really badly timed budget. It's all well and good having tax cuts, and it's all well and good sort of trying to spur the economy on. Let's take a look at what the latest budget has been. It looks nothing but death and doom, according to certain newspapers, and even the Bank of England and the Chancellor come out and said, we've got 2 years of storm ahead of us. It's not really what you want to hear from the people setting the rates. The irony is that what happens is we tend to not have as bad a time as what the doom mongers say, and what tends to happen is they then say, well, look, it's because of what we did that we actually saved it. But what we've got to look at here as well is this particular budget, for me, actually could have spurred on quite a bit of growth. But what they didn't do is they didn't say how they were going to save the money. If they come out and did a budget and waited a month or two to making that statement and said, this is how we're going to actually save money, this is what we're going to do to actually save the amount that we're going to sort of cut taxes by, then it would have been deemed and seen in a whole different light. So that's important moving forward. What we need to see from a government is they want stability, but importantly as well, something else that we saw is when the Bank of England are pulling in one direction, taking money out of people's pockets, and then you've got the UK government actually putting money in people's pockets. You've got two major institutions pulling in different directions, and of course it just doesn't work. It's as simple as that. So in terms of why it failed, they had to start reversing, and once they reversed one thing, then the whole thing spiraled, and they had to then keep going. And of course, after that, then it just spiraled out of control. So as we then sort of move on, and we can see that, as I mentioned, the government was putting money in people's pockets while the BA was taking it out. Then, of course, what happens there is they then start to think, well, actually, we're going to spike, and inflation is going to keep going up and keep increasing. And we're going to come on to inflation in a bit, because there's two things that we need to look at here. There's the inflation that we see that you guys read about in the papers, but there's also core inflation, which is a lot less. But the Bank of England are really trying to curb that that steep inflationary rise. So let's have a look at inflation, and let's talk about what the rates are. Now, there's a number of inflation rates. There's core inflation, RPI, CPI, and what you guys see every day in papers, we saw that the CPI was sitting at 11.1%. That was the latest. So if you just do any basic search on BBC, you can just see that the CPI was sitting at 11.1%. That was the latest inflation rate. Now, that looks horrific on the face of it. But also there's something that's called core inflation. Now, that's once you've taken out energy costs and cost of food. Because actually, if you look at what's happening with the cost of food, well, a lot of it is increasing because grain isn't getting out and cereals aren't getting out of Ukraine. Energy costs are going up because everything that's happening in the Ukraine crisis. So that one crisis alone is causing a great deal of inflation with energy and food. But if you take energy and food out of the equation, that actually brings core inflation back to 6.5%. That's a big difference from 11.1 back to 6.5. It's still high, but again, it's a major difference. Now, the reality is we have to look at how we've got to this 6.5%. A huge amount of money has been created in the last 2 years in the States and in the UK. Since COVID, they printed money like it was going out of fashion. And actually, the exact stats are, we're talking 40% of all the wealth in America. So 40% of every dollar in America has been created in the last 2 years by printing. Within the UK, it's over 15%. We're close to 20% of all the UK wealth created in the last 2 years. So 20% has been created in the last 2 years. Now, that's a huge amount. If you create wealth on that level within a matter of years, you're going to have inflation. You're bound to get it. So the reality is there was always going to be inflation, and that they kind of predicted around 5 to 6% inflation. What they didn't account for is issues like the Ukraine crisis and the Russia crisis that we're seeing. But actually, if we take that out of it, we're actually only at 6.5% inflation. Now, if we look back and if we head back to 2016, I believe it was, and I think the time before that was maybe 2011, core inflation there, or inflation then, was actually 3.7 or 3.8%, I believe, in sort of 2011, and 3.5% in 2016. So actually, we're not massively higher than that. We're 3% higher, but we're not hugely high. We're not sort of talking where we're sort of 10, 11% on core inflation. And actually, interest rates at the time were around 0.5% throughout that period. So if we look back on those times when core inflation reached 3.8% or 3.5%, the Bank of England just left rates where they were. So it's going to be interesting to see what happens when that core inflation starts to come down, which it will. That core inflation will start to come down back to sort of 4.5%, maybe even under the 4% where we were in 2011. It's going to be really interesting to see what the bank does and what the Bank of England do in regards to their actual rates and what they actually do with them. Because before, as I say, they kept them at the 0.5%. Now, a lot of people ask me, do I feel that they're going to be going back to 0.5%? Not a chance. I think that ship sailed. Those cheap lending, those cheap mortgages have gone, basically. Those times about borrowing 1.89. We've got clients here who borrowed at 1.89% on a buy-to-let. I think those days have gone. But as you can see here, so the core inflation 3.7 in 2011, and once that starts to reduce, we do actually see the Bank of England pulling rates back. They've already stated that they're going to pull back once under control. So I think what we're probably typically going to see over the next 6 months, we'll probably see another rise, not a 0.75% rise, but maybe a 0.25 or 0.5% rise by the end of the year. Probably see another one in Feb, and then they'll sort of see where inflation is. They'll see what's happening in the Ukraine crisis, and then we'll start to see by the middle to end of next year we're looking to see the rates actually come back down. And I probably think we'll end up back to the 2.5% mark, give or take. And if we can get back to that 2.5% mark in regards to where the Bank of England are sitting, the mortgage rates are going to reduce over the longer term. So that's why the majority of the projects that we're actually advising on selling at the moment are actually off plan. They're 12, 18 months, some 24 months down the line, because we expect the mortgage rates to start to fall over that time period. Another thing is as well is the pound. So the pound has got stronger. We've recently seen it as low as 1.04 when the mini budget hit. And there was the issues around that. But of course, we're now starting to see the pound recover, and we've seen it getting a lot stronger to 1.19. Now, I think we're going to start to see 1.22, 1.24 by the end of the year. And we'll start to see that pound increase as people get a little bit more confident in the pound and the government and how they're running things. So I actually see overall inflation coming down, especially core inflation. And I see that by the end of next year, we should be in a totally different position. So importantly as well, how has this affected the mortgage market? Now, we saw it was chaos where we had a huge amount of residential and buy-to-let mortgages just pulled from the market totally. We've seen the recent rise in the interest rate from 2.25 to 3%. It actually didn't have much of an impact because the mortgage market, it was so chaotic after the mini budget that what basically happened is mortgage lenders, they just withdrew from the market totally. So what we then basically saw was once the increase of 0.75% come in, lenders were saying, well, actually, we're kind of already at that point anyway. So there wasn't actually any major reason for a change. So that recent 0.75% didn't actually have too much of an impact. It was actually already factored in. So then we look at what else is happening. Now, the market is expected to settle, as we mentioned, over the next 12 to 18 months, typically as we start to see inflation come back, which is expected to do. We're actually going to be launching a new podcast series at the beginning of next year where we have sort of experts on. We've got some behavioural economists that are lined up, but the first one's going to be a mortgage broker. We spoke to a huge amount of mortgage brokers, and we're looking at when they expect rates to come back, and they all expect rates to come down by the end of next year. So we've got a great podcast coming up the start of next year where we're going to talk to mortgage brokers specifically and how they see the market, and when they speak to lenders, what conversations are they having. As I said, we don't expect them to go back the rates this is. We don't expect the Bank of England to bring rates back down to 0.5%. We think that's done. But potentially, as I say, 2.5% mark, we can actually see that coming back down, which will mean mortgage rates back to 3.5%, give or take. And then we suddenly become back to, that's when it's worth getting mortgages again, maybe fixing it for 2 or 5 years. But as I say, that's probably not going to be for 12 to 18 months yet, hence why we're advising people buy off plan and look to the future rather than getting something that's ready now. So what do we see happening and do you invest? Now, this is important as well. There's a couple of things we're going to run through here. One is making the current market work for you, but also, is it worth buying now? Because let's be realistic. The majority of people that we speak to, their biggest concern is that they're going to buy a property now and then it falls a week later, a month later, 3 months later, and they could have bought it 15% below what they've paid for it. But that doesn't happen. It's not like the stock market. If we go back to March 2020, when the stock market fell 30%, you could have literally waited a month and bought the same stock for 30% discount. That doesn't happen in the property market. If you look at previous decades and previous downturns, let's go back to 2007, 2008, 9, which most people remember. There was a downturn of 15% during that time. However, city centres didn't fall overnight. So they certainly didn't have a property, just if you look behind me at Canary Wharf now, you didn't have a property there that was, for example, £1 million today, and then a month later, it was 15% discounted. It just didn't happen. It fell over a period of 18 months, and then it started to recover over a period of a little bit longer. But the reality is that most people say, well, if I'd have waited till 2008, I could have saved 15%, but that's not true. You would have had to have waited 18 months to get to the bottom. So if you'd have waited 18 months to get from that top to the bottom, well, during that 18-month period, you would have actually made more than the discount that you'd have got anyway. So we can make people more than 15% over an 18-month period from 2007 to 2009. So the reality is you wouldn't have actually been better waiting. Because they don't fall in a straight line. And it's the same now. Is do we think there's going to be a crash? No. Do we think there's going to be a minor correction? Potentially. But what are we looking at? I mean, the OBR, the Office of Borrowing Responsibility, they've said 9% correction. Well, 9%. The property market's gone up 9% in the last year. So we're actually only going to save ourselves a year. You've got the Knight Frank now saying there may only be a 4 to 5% correction because the government in their latest budget, they actually softened the blow where people who would normally struggle, they could get help with their mortgages. So if we only see a 4 or 5% correction, you may see that over an 18-month period. But during that 18-month period, and this is important as well, over that 18 months, if you save yourself 5%, well, the person that's actually bought, we could have made them sort of 12 to 15%. So actually, you're still better off, ironically, even if you see a 5 or 10% correction. Now, don't get me wrong, if we see a 30% correction, totally different ballgame. But we just don't think we're anywhere near that kind of correction or crash in that case it would be. So we're still saying to people that we do think that 2023 is still going to be a great year for rentals because rentals are going up. We saw recently that the biggest increase was last month in rentals, 3.8% increase nationally. It's the biggest increase in rentals on record. So we know that people are getting more rent than ever. But as I say, the main thing that people have got to understand here, the property market doesn't crash overnight. It doesn't have a correction overnight. It takes at least 12 to 18 months for a correction or a crash to take place. So by that time, you would have made it in income anyway. And listen, the best thing to do is let's be realistic. During times like this is the time to get involved because you can go and squeeze a developer. You can say to a developer, look, I'm going to bid you 5% down. I'm going to bid you 10% down. You're not going to get 10% off. But if you get, if you get up to 5% off, well, fantastic. You've saved yourself 5% as well. So now's the time when we can go in and we can use what's happening in the general market to give developers a bit of a headache and, try and bid them down as well. So use this time wisely. And importantly as well, as I said, in 2008, the decrease took 15% took place over 15 to 16 months. So even if you bought at the height, you'd have still made this back on income. That's the important thing. And as I say, we feel that there's going to be a correction. We certainly don't feel that there's going to be a crash. So we still think it's absolutely solid time to buy. And then, of course, how do we make the market work for you? Now, this is important as well. You've got to speak to a broker. We don't just say, go and get something anywhere, because what we do feel is, whereas COVID inflated the prices on the outskirts in the suburbs where people had space and gardens, we think they're going to be the first places that fall. We're already seeing it at the moment. Certain places in the suburbs are coming back, and the city centres are actually increasing as people want to be back in the city, jobs, etc. So you've got to speak to brokers who have been around and seen this before. Most of the stuff that we're going through now, we've seen it on a much larger scale in 2007, 2008. And there are some people that are working for us that are old enough who remember the late 80s as well. So not many of them, but some of them. So if you speak to people on what happened then, the late 80s, early 90s, that was one of the biggest crashes, where we had liquidity issues and interest rates up at 16%. Look at historical pricing as well. Don't just think that things are going to crash. Look at what things do in the stock market, where they do crash instantaneously and go up a lot quicker. But look at things, what they do in the property market, where they drift down slower rate and they come up at a slower rate. So you've got to look at historical prices, and would you have been better to wait in 2007 to 2009? And on the whole, it's probably the answer is no. You could have still got in at 2007 and made great gains. Have your property fully managed. Again, this is key, because more and more at the moment, if there is an affordability crisis to people that are first-time buyers, well, they rent for longer. So they rent for longer, which is great for landlords because it's pushing rents up. But the reality is there are going to be some people who may struggle to afford your rent. The last thing you want to be doing is chasing clients and trying to get the rent out of them. That's something that we do, or you can use another management company that would do that. And ensure that you're in up and coming areas or solid areas. So you might have, for example, the Manchesters or the Liverpools or even the Londons, but don't go and buy slap bang where the most expensive. But for example, Kensington, Chelsea, Fulham, expensive areas in London. But what you don't want to be doing is buying there, because the rates in terms of what you're going to get back on the rent are going to be so low in comparison to the percentage what you paid for the property. You want to be getting areas in London which are going through that now and going to be up and coming in London. Same with Manchester and the same with Liverpool. So as I say, guys, is it the perfect time to invest? No, there's no such thing as the perfect time to invest. Would you have made more money if you invested 2 years ago? Yes. But are you going to make more money if you wait? No, that's the reality of it. So we can't keep looking in hindsight and saying, oh, I should have invested 4 or 5 years ago. That's done, that's been and gone. But are you going to be better to wait? Again, no, that's the reality of it. We've proven it. We've done our stats on it. So the reality is, guys, it's still a good time to invest. We just have to be a bit more intelligent, because the reality is what we say to everyone is the price of the property, ironically, is not what you pay for it. This is key. So if you go and pay 200, 300,000 pounds for a property, that's not the price that you've got that property for. The price of the property is what you've, not only what you've paid for it, but the interest that you've paid back on your mortgage as well. Because if you bought a property for 300,000 and you paid 300,000 interest, you've actually paid 600,000 for that property. That's the reality of it. Whereas if we buy something off plan now, and we can save interest payments, and we actually only pay 200,000 pounds interest rather than 300, well, that same property has cost you 500,000 overall rather than the 600. So you need to be clever about things. We need to be intelligent and say, right, when do we expect rates to come back? Well, let's buy some properties and let's aim for that. And let's, use the pain that was going on with developers at the moment, and let's start bidding them down. So over to you guys. You should have sort of, I think you can either raise your hand on these things or question and answer sessions. So yeah, you guys feel free to ask any questions, and we can run through them. Let's have a look at the first question here. Do we think rates will drop back to 2.5% or 2%? Most people are saying around 3%. Yes, good question. So yeah, I genuinely do. I spoke to a lot of interest rate traders, and there's always predictions. So what you'll see is you can get Bank of England predictions from 2016, 18, 2020, 2022, etc. And all those predictions would have changed to the point where you think, what's the point of making predictions? Because none of them have happened. So in 2016, 18 and 2020, their predicted rate was maximum 0.75%. They did not expect it to go up, but they have. They put it up to 3% and probably going to go higher by the end of the year. So the reality is that what they predict is going to happen is largely irrelevant. Now, a lot of people have factored in interest rates of 3.5% for the foreseeable. I don't think that's going to happen, because that will cause too much of a squeeze and too much of a pain on many people, on homeowners especially. So what they're going to try and do is, whilst people are in their fixed mortgages, no problem at all. People are in their fixed mortgages, they're still paying 1.892%, no problem. When they start to come out of the fixed mortgages, that's when we're going to see the pain in 12 to 18 months' time. So the Bank of England want to get this inflation, especially the core inflation, under control ASAP. Once that starts to come back down, they can then start to bring the actual interest rate back down. So it's going to be a bit like ripping off a Band-Aid. They're going to try and get it done as soon as possible, bring the inflation back down. Then when people start to come out of their fixed mortgages, then they will start to have lower interest rates, hence lower interest rates. So yes, I do see it coming back down to 2.5%. How do you know or forecast the value of an off-plan property in the future? Okay, that's a really good question. So what we can typically do is you just look at if it was ready now. The first thing to do is a very basic search on anything. Rightmove, Zoopla, anyone can do it. You can do a basic search. So if I bought, let's say that this tower behind me was residential. It's not, but let's imagine that it was. We could go and do a basic search to say a one bed in there would be coming in at roughly 900,000. So let's say that there's a new development, which there is, a few blocks down, and the one beds in there are going for £1 million. Well, we know it's over the top. If I can go and get something ready there, that's 900,000, a one bed, or £1 million that's off plan, it's over the top. But if I can then go and get that off plan one 3 blocks away for 800,000, well, I know that I've saved myself 100,000 for buying off plan. So all we basically do is we just do a basic search to make sure on the ones that are ready now are coming up slightly over, or if not the same as what I'm getting off plan. Because what we also have to take into consideration is the actual age of the property. So this behind me may be 10 years old, might need work, may need a bit of wear and tear, might have a higher service charge, whereas the new one might have all the latest tech, therefore I'm going to be paying a bit of a premium. So there's multiple things that we have to factor in, but a very basic and a crude way of doing it is your basic Rightmove and Zoopla search, and just make sure you're not overpaying for the area. What happens to the value of the off-plan property if it's below buying when it's ready? Again, that can happen. So what we typically say at the start is you buy something that is that stacks up in terms of the area. There's two things to take into consideration. It's very unlikely that you're going to buy something that has a lower value in 18 months' time. What it might have, and what's happened and what we've seen recently, is the valuations have come in lower. Now, there are two different things. The value and the valuations are two different things. The value is something that someone is willing to pay for it. The valuation is what a lender is willing to lend on it. So we've had one that's completed in Manchester recently. The value easily stacks up 150, 160. We know that if we go and put that on the market now, we could go and get that no problem at all, or maybe even a little bit more, 160, 170, some of the recent ones are sold for. But from a valuation perspective, lenders are coming in and they're actually turning around and saying, well, actually, we're going to discount it by 10, 15, or even 20% because they're nervous about the market. So there's two different things there. So it's very unlikely that you will buy an off-plan property and the value of it will be less in 18 months to 2 years time. But the valuations, yes, they could be less because that's just the mortgage market at the moment. And they're happening everywhere, not just in investor-led properties, but we've had residential properties. There's one in Surrey that we had recently. It was £800,000 property, perfectly normal 5-bed family house. And they valued it at 7 or 720, something like that. They discounted it by 10%. Not that it's worth less, it's just that's what they are willing to lend on it, if that makes sense. So what else we've got here? In terms of areas, has much changed in regards to areas in terms of where to invest? Not particularly, if I'm honest. We're still seeing that the north is outperforming the south in terms of where to buy and actual price points, but we're also seeing the rents actually increase more up north than we are down south as well. A lot of people actually bought on coastal areas down sort of southwest. If you look at places like Devon and Cornwall, we are seeing those areas, now the prices come down quicker in those areas. Southeast, in the suburbs, we're seeing prices come down there where, you know, where everyone was having staycations before and they were lapping up Cornwall and Devon, places like that. Now, not so much. So we're seeing prices fall there. That's where we're going to start to see the prices fall at the quickest, at the earliest. But we're still seeing that the north of England, and if we show you a Zoopla report, you can still see that the property price is still growing. Not as quick as they did last year, but they're still growing. But importantly as well, it's still the same Nottingham's, Liverpool, Leeds, Manchester, those kind of areas that are still performing. Now, someone's got their hand up. You might have to type it if you can. I'm sorry. So someone's put their hand up. If you can click the Q&A down the bottom, you might be able to type it, as it's not allowing me to. It's not allowing me to allow you to talk. So apologies. Another one here: mortgage rates. How do we know mortgage rates aren't going to be 6-7% in 2 years' time? We don't. Is the honest answer. The reality is if mortgage rates are coming in at 6, 7, or 8% in 2 years' time, then I think that there's going to be bigger issues in the market, as we will see a lot of people who have got residential mortgages on 2-2.5%. They've got them at 2-2.5% now coming out of their fixed terms. If they suddenly get, you know, jacked up to 7 or 8%, then of course there's going to be major affordability issues. Now, what we've got to understand here is the property market is one of the biggest tax generators for the UK. It just is what it is. So what basically happens is they generate tax on stamp duty. So when a lot of transactions go through for the government, it's fantastic when people are buying and selling all the time because it's constant stamp duty coming in. It's a great tax revenues, the property market, and of course it's what else it feeds. Well, it feeds estate agents, it feeds lawyers, it feeds councils in terms of council tax paid. So it's fantastic, and of course it feeds developers, and the whole industry is absolutely huge. So they don't want it to fall. So the reality is the Bank of England are on a knife edge where they've got to reduce inflation, but they don't want the economy to stall so much where it's absolutely grim out there. So that's why we're pretty confident, and it's not just us, it's a number of, we spoke to, say, normal economists, behavioural economists, we spoke to mortgage brokers, and they all think by this time next year, we're going to be in a totally different position, and we're going to start to see those rates come back. Well, look, guys, I hope that helps. Anything you need, feel free to call in or email in. And I look forward to speaking to you. I think we've got one webinar just before Christmas. And if I don't speak to you before then, have a lovely rest of the month. Take care.